What's going on, Hot Take of the Day listeners? DRW here. Before we start the show, I want to start with a thank you to one of the friends of the show and take a quick minute to introduce API Control Systems, who specializes in control panel fabrication, skid packaged automation, and instrumentation and electrical installations for the oil and gas industry as well as other industries. During a recent show with well-known CEO, he said that when companies try to do too many things, it's very rare that they're successful. And in the words of Mr. Chris Wright, if you're going to be really good at something, you better be deeply focused on it. Well, for over 3 decades, API has been focused on building control panels such as PLC panels for compressor stations, hydraulic well control systems, drilling choke consoles, and skid packaged automation such as hydraulic power and chemical injection skids for deep water projects, and safely installing them. As you know, my sign off, be safe, be good. Safety is always first. Whether electronic, hydraulic, pneumatic, they have the expertise and enthusiasm with their hardworking team. API has a great culture and a lot of long-time employees. They're responsive and they partner with a wide variety of companies from the super majors down to local municipalities. Last year, 2 longtime employees acquired the company, having started there at entry-level positions over 20 years ago, which is a cool example of patience, perseverance, and the American dream. If you want to learn more about API, please go to apicontrolsystems.com and consider giving this fun team a shot at your next panel fabrication or I&E installation project. They're based in Louisiana, they're ready to travel, and again, their website is apicontrolsystems.com. Contact information is there, and when you ask for them, ask for Lucas Como and tell him you want the Hot Take of the Day DRW discount. Thanks for listening. Now on with our show.
What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. And we are going back to the well with one of my favorite guests, Josh Young, because, Josh, when was the last time you were on? I was thinking it's got to be 5 months ago.
It was beginning of May.
Beginning of May. And so, we were fresh into 2 weeks to flatten the curve, and we were only 8 weeks in at that point. And energy was well on its way to a short surge to mid-June before an epic crash, which reversed last Monday on news of the vaccine. And you were a value guy, and I'm curious how you have been interpreting and responding to the markets sort of cycling out of high-growth tech and into long-term value cyclicals with the news of vaccine. So first of all, welcome to the show, but then give us your thoughts.
Great question. Great to be on again. And man, the world's exactly the same as it was in May, right?
It's currently March 237th today. Still Monday.
It's shocking. I mean, I think just I'll say one thing, which is it's amazing how much people will say follow the science and how little they actually follow the science from a policy perspective.
You want to expand on that?
Yeah, I mean, I went to the University of Chicago. I talked about this a lot in a recent podcast on Market Huddle. They actually titled it, the Chicago School Take on Investing or whatever, but with a value tinge. And so from the University of Chicago economics perspective, I guess the Cato Institute kind of is the most aligned from a policy take. And they like to say that more often than market failures, you see regulatory failures. And so what we're seeing right now is just this unmitigated disaster where everyone would tell you what we're doing is wrong. Some people would tell you we should do more of this thing, and some people would tell you we should do more of that thing, but everyone would tell you what we're doing is wrong. And you're seeing politicians just double and triple and quadruple down on things that are wrong, and everyone knows are wrong. So it's pretty tough.
What do you think is the most wrong? Because I agree, but let's break down the wrong in categories that are digestible.
So it's hard because I live in a glass house, and so it's easy to be general in throwing stones, and it's really hard to be specific with those stones, because as you throw stones, people would say, hey, okay, well, you thought this COVID thing was less serious. And it's amazing because my thought was always that the cruise ship was the best example of what would happen. And it was like a 0.4% mortality rate or something on the cruise ship.
Yeah, when you age adjusted the Diamond Princess, and for those listeners we've been talking about a lot, there were 3,700 passenger and crew. This is a novel coronavirus, not the first and not the last. And so out of those, with no masks, no ventilation, a cruise ship that was just sailing the ocean for 30 days, 700 people became infected. Now it takes 95th percentile is 4 to 6 days to get infected. So given that you're in a cruise ship, you can surmise that everyone was mixing and cycling and turning for those 700 infections. So that sort of implied an 80% existing herd immunity for whatever reason. And then of those 700, 7 died initially. I think long-term 14 died, but they were all old because that's the population of cruise ships, old obese people. And when you adjust that down to a fatality rate, it was 0.4%, is how I recall it, given that was the data that we all had in March to make the lockdown decision on.
Yeah, exactly. And to one of the things you said, in the long run, we all die, right? It's like the certainties are death and taxes. And so, when you start fighting certainties, and when you look at things on a morbidity adjusted basis, from a policy perspective, I think this whole thing has been navigated poorly. I think I'm in your camp in terms of the stay-at-home orders being a massive mistake. When you meet, I've always been interested in epidemiology because I'm interested in data and data analysis, and econometrics, which I loved in school and amazingly ended up doing well, and even though it was like a very weird, wonky thing, has a lot in common with epidemiology. And so there's a lot of like techniques that you learn and perfect in econometrics that are directly applicable, and you can like look at the same data sets and figure out some similar things. When you push an epidemiologist on it analytically, they all agree. I mean, like there's, what you do with this sort of thing is you find your weakest and most vulnerable set, as well as your kind of super spreaders, and you quarantine them or substantially reduce their activity, and then you let everyone else go. And you get herd immunity, you get other benefits or whatever. But even if you don't do any of that, once you have a vaccine, you go and do the same thing where you go vaccinate all those people, and everyone's like, oh, well, I mean, I don't know, I probably should not get into this too much.
Well, but I think, and again, I think that this is such an interesting topic because, in order to understand energy and in order to understand investing and the economy and Main Street versus Wall Street, the only thing that one has to be doing right now is making a call on policy and regulations vis-a-vis the way we're going to go. Because what I find amazing, and I'm very curious your thoughts on this. So the vaccine is announced last Monday by Pfizer. The timing is obviously hilarious because it was 7 days after the election, and the market goes crazy. Now it sold off a little bit, but generally what we saw was this massive move to value. And in particular, we saw guys like Chevron, like Exxon, where in the middle of the previous week, everyone had gone bearish. And they were like, the demand story is horrible, lockdowns are happening, like this is awful. I think Chevron was trading at like 71, Exxon was 32. Everyone was throwing in the towel and being like, oh my gosh, here it comes. And on Monday, vaccine comes, oil jumps 8%, goes back to the 40s, and the party is on, and everyone is betting that oil demand is going up. So notwithstanding the controversy around COVID is kind of the pinnacle. And this vaccine, I'm curious what your response to the Pfizer and then the Moderna announcements over the last 2 Mondays were.
I'm going to politely decline to comment on that. What I will point out is that I strongly disagree that the only thing that matters for investing or oil and gas investing is what happens around this vaccine or around the COVID policies. I do think that policy analysis is important, but this like new mantra of build back better is terrifying and worth observing, because there was first the climate change stuff and then the COVID stuff, and now it's both, and then it's other, it's kind of this like weird, aggressive socialist, highly regulatory, highly kind of centralized control agenda. There's words that we don't use anymore, like socialism or communism, or fascism is used a lot, but those other two isms are not. I think it's really important to be aware of those because there's a very rapidly, highly increasing risk of a knock on your door or your office, and it's the government, and they're here to help. And one of our best presidents over the last history of our republic warned us about that, and kicked off this incredible period of economic growth in the 80s that we're still benefiting from. Our generation and our parents' generation are way better off than our grandparents and great-grandparents, partly because of that awareness and those policy changes. So I think it's important to follow the COVID stuff, but it's kind of a signal, and it's scary in terms of what may be coming potentially.
Yeah, so that's a great lead into how do you see a Biden administration? There was lots of debate. I had Ellen Wald on the podcast, and she was pretty clear about, we talked about what was Biden's stance on fracking, and she said Biden will go with whatever the room wants him to go with, so it really matters what the others want. And obviously Kamala has been out there previously with fracking bans, but you and I both know I don't believe the president can do it. I think under Obama it was shown that they can, but there's lots of things that they can do. For instance, regulating methane emissions. For instance, making every live wellbore that you own have a $50,000 abandonment bond, which would basically bankrupt the industry, or not allowing fresh water to be used in fracking. Any of those would have the exact same impact as a fracking.
This is one of the fun things about COVID world is mail delivery in the middle of a.
Oh yeah, it's all part of the work from home. But what? So where do you see Biden and when you talk about those risks and the Ronald Reagan, if I test my history, we're the government and we're here to help concept. What do you see as the coming risk?
So under the Obama administration, I saw this interesting comment recently where someone said either you are aware of how onerous the government regulations were that Obama and his administration put in the 8 years that they were in office, or you didn't have a job that, I forget exactly what the phraseology was, but either it was awful, or you weren't running a real business that was of substance and whatever.
Right.
And so if you're aware of that and you pay attention to that, you think about that, that's the risk. It's not really the big headline stuff. The headline stuff is bad. We'll see. There's kind of this running joke about the weekend at Bernie's, so it might be the presidency at Bernie's. But it's not really about the person, right? It wasn't really about Obama per se. It was about the astonishing buildup of bureaucracy and regulation and kind of the corpus of the state, similar to the USSR, similar to Maoist China, these sorts of states and bureaucratic entities. And we're seeing it with modern corporate America too, to some extent too. I think once you have the administrators that manage the administrators that have the HR people and the legal and the whatever all around, you end up in a situation where you have just increasingly poor decision-making that's increasingly disconnected from adding value to the kind of end consumer or citizen or whatever. And it's kind of the problem that people were identifying with the oil majors, where, to Chevron and Exxon's credit, they're not doing what some of the other, I guess, even worse oil majors are doing. They still have their own bureaucracy issues, and people are identifying, hey, these guys are not in it for us to create value, and that's kind of where their shares fell. But at least they're not BP aggressively pursuing negative return projects to greenwash themselves. But you see that from a government perspective too. So I think there's a lot of risk there. And, I think bringing it back to the topic at hand, I think it matters a lot for what I want to own and where the opportunity set is. And I think you and I actually have a very different take on investing, and I'm excited to talk about this a little more. I think we have opposite positioning right now, and happy to share why I own oil stocks and why I think you're too focused on a shorter time frame, and why I think things do extremely well over the next 5 to 10 years.
Yeah, I think that would be great. But before we do that, I did want to ask your opinion. Do you think, given the regulatory burden that happened under Obama, the knowledge of this, I find it fascinating that the way the market has invented a narrative where, Biden, even though corporate taxes are going up, even though regulations are going up, even though capital gains taxes are going up, somehow that's no longer a bad thing. It's a good thing because of stimulus. But then the miracle of miracles happened against all the polling odds, which was all of a sudden it was a split Congress. So now that was even better than the blue wave, which was supposed to be good. And there's still those 2 Senate seats in Georgia, which, regardless of your view on cheating or not cheating in the election, if you believe there is the ability to cheat and there is the motivation to cheat, then you have 2 Senate seats that are being run off January 5th, that in the event those go Democratic, the whole split Senate narrative that is the reason people don't believe that things will get done in Congress goes away. So if you're one of those tinfoil hat people that believes that there was cheating or influence, and I personally believe the influence was in the polling, in that if you believed in Wisconsin Trump was going to lose by 10 percentage points, you were more likely to throw your vote away for a libertarian candidate than you would have if you believed that your state mattered. So in Colorado, I have a lot of libertarian friends who would have voted Donald Trump if they felt like there was a chance he could carry Colorado. But since there was no chance, no one did. And when you look at Wisconsin, the last I looked, the Joe Jorgensen amount of votes was precisely what Trump would have needed to win Wisconsin. And same in Nevada, and same in Arizona. And if the polls hadn't told libertarian Republicans that they shouldn't even worry about it, then there's a chance that they wouldn't have thrown their vote away, and there's a chance the election would have come out. But with all that being said, why do you think the market is so euphoric and just every bit of news is an up news, given what we know about Democrat administrations?
So, I mean, there's a lot to say in response to that. One thing I'll say is that I come out of a world of public securities where fraud is rampant, and in some cases, it's harder to identify than what we saw with this election. So this concept of 138,000 votes showing up in one instant, 100% for one candidate, and there being no ability to audit that or to validate it, and there being conflicted ownership of apparently that voting machine company and other stuff. I mean, it's like, you would pass on an investment that had way fewer signs of fraud than that. So I guess that's what I'll say about that is just, there's like massive, you just train yourself in public equities, especially if you do smaller cap stuff like I do, to avoid these. Since I used to short stuff like this, and man, this would be like, if this was a company, you would like figure out kind of when you're getting squeezed, you wait for the squeeze, and then you just pound it because that thing would be going to zero.
Yeah.
So
you believe that there is ample evidence, but they won't be able to be resolved, that there is ample evidence that there was fraud.
I believe that that pump and dumps end up with dumps, and that people behave according to their economic incentives. And I think that there's lots of breadcrumbs and lots of interesting things that would be similar to kind of what you'd find if you were finding a stock that's short. And the timing is great because the S&P 500 just included Tesla, and
which I know which you have a view on Tesla as an organization.
Yeah, Tesla's amazing. Tesla, I was seeing apparently on some of their models and some of their versions, they have a 30% failure rate on their cars, and the NTSB won't like issue a recall. And so even like operationally, like forget the financials, forget that they've made all their money, to the extent they've made any money on like selling electric vehicle credits and carbon credits and other kind of like artificial government constructed things, and that they've taken these interest-free loans and all this other stuff, and ignoring the corporate governance and ignoring all that other stuff. Just fundamentally, the cars themselves break all the time. And amazingly, owners will just ignore it and say, hey, we love this. We like have this like positive sentiment. Maybe it's greenwashing, maybe it's whatever. But, I think in that world, in a world where Tesla, where Elon Musk is one of the wealthiest people in the world after like violating securities laws. Like everyone, there's no debate that he did it, right? Like the 420 tweet, like that was illegal. So in that world, maybe it's not so weird to see this sort of election stuff. Maybe that's like what we should expect rather than be surprised by.
Right. Well, and it's hard not to be a cynic when you see that. And I agree with you on the Tesla. There's a lot of people who have pointed to a lot of irregularities. And when I look at their profitability and the fact that they're a $400 billion company now, and I think their revenue in 2019 was somewhere around 25 billion, and the profitability was selling carbon credits into a market that doesn't necessarily even really exist, which comes back to your regulatory point, that you can corner the market on a carbon credit, which is actually not reducing carbon. It's just simply transferring wealth from one capitalist organization to another based on a regulation. It is truly, I sometimes feel like we're in the land of Oz and worse, 1984 by George Orwell, which I finished recently, and it was terrifying. But let's pivot to, because a lot of listeners say, Dear Dubs, I want you to get people on the podcast that have a different view than you. And I think on this front, let's talk about your view of oil and oil stocks and why you're long, and why you feel constructive on valuations at this level, and be specific about like the where and the what and the how and the who. And then we can have a debate about that for all the listeners that have been asking for this forever.
Cool. And before we get into that, I should probably talk a little bit about what I avoid, which is, some of the same kind of like corporate bloat and bureaucratic bloat stuff like we talked about with the oil majors, both the US ones, which have these like weird aspirations like growing to 1 million barrels a day in West Texas, or the international ones like, hey, we're going to be a solar company, even though our core competency is oil and gas. Or blowing up wells in the Gulf of Mexico, or whatever that might be.
As a random, non-specific example.
Yeah, exactly, as a non-specific example. Or, whether it's, some other weird incentive issues, like whether it's private equity funds or activists, like vending in assets into public companies and then like pushing them to, sell at bad times, or then arguing with management teams after like they vended in those assets. And it's like, okay, well, is it bad management, but they were willing to buy this private equity fund or activist assets, and then, somehow those assets were good, but people were bad, but if the decision was bad, I don't know, there's like a lot of kind of interesting conflicts, and some of that's been in the news recently, and it's very like interesting to see how positively some of these things are responded to, at least in news reports, but then the stocks go down and there's no value created. So having to navigate away from a lot of that is necessary, and I think it's less about an index and more about specific opportunities that are differentiated.
Okay. So what are you, if I were to make a guess of things that you were positive on, I would suggest you're probably long-term E&Ps with lots of inventory and assets. And I would imagine that would fall on a Canadian company side. So like a Cenovus, like a Suncor, as two large cap examples people in the US might be familiar with. Is that a fair guess in terms of the value thesis, or are there some oily names, and we'll talk natural gas as well, but are there some names that would surprise me that you would be long right now?
So I can tell you why I don't own both of those specific companies, but kind of generally I prefer things that are less well covered from a research perspective and less well like known or understood even by oil and gas specialists. And my preference is to own things that no one knows about and no one really understands, or very few people know about or understand, or that people know about and like really viciously hate. And so I think we can talk about one example of each, and actually, the one that people don't really know about and talk about in Canada and that people just hate, like you tell them the name and they think about how they lost money on it already. And those are kind of things that make more sense to me than trying to like be the world's expert in like oil sands or whatever. But I will, for a second, talk about Suncor and Sonova since you mentioned them. So Suncor stock way outperformed versus its peers over this like oil price downturn, even though it was really composed of like lower quality oil sands assets and lower quality refining assets. And they had like very weird like lobbying things, similar to how like the oil majors were like anti like the Texas Railroad Commission doing rational things to maximize royalties collected by the Railroad Commission, because of some weird philosophical, oh, you shouldn't intervene, but you do intervene, but just don't intervene like this sort of stuff. So Suncor did that in Canada aggressively, bizarrely aggressively. But like you kind of have this like set of lower tier assets that were awarded a very high valuation, similar to the oil majors, where there was this idea that somehow you were immune from demand shocks if you owned refining and midstream, or at least midstream contracts and upstream, when the reality was if you have low quality of each of those, there are points in the economic cycle where you'll do quite poorly. And Suncor has done that, and the stock has started to fall. It's rebounded a little bit recently, but like, so to me, that's not that interesting. And then Cenovus is super high quality, and they're merging with Husky, which is extremely low quality, to become like an inferior Suncor. So I don't know. I mean, lower valuation, but similar sort of issue.
So no, that's fair. And I liked your kickoff point. Now, I happen to have some inside baseball on the two names that viscerally make people in the US and in Canada react like they just got punched in the face. And I think if I'm right, we're going to be talking about Crescent Point on the north and Sandridge on the south. How did I do?
Yeah, half right. So we aren't going to talk about Crescent Point. Crescent Point has actually good management, but a questionable board. I guess that's like that's the Canadian way to say it. But yeah, Sandridge definitely really interesting on the west side. And I think we should probably talk about Tamarack on the Canadian side, in terms of just like what a good board and management can do, and kind of what things look like when they go well and are still interesting to own.
Well, let's start with Sandridge, because, I think it sets up a longer discussion around the natural gas bull thesis. And certainly going to March and believing, as I did, I know you did, and many have written about, that the lower oil price was going to lead to less oil production in the U.S., which was going to lead to less associated gas production, which if 4 million barrels a day declined from the peak, so the peak was near 13, declined 4 to 9, the average oil well in the United States from the basins I'm talking about has about a 4,000 GOR. So that implies 16 BCF a day of associated gas that would come off just through natural declines. And, obviously GORs rise through time, that offsets some of that, but that sets up a bullish thesis. And I think we've seen, natural gas ran up to 320, 330, 340. People were feeling great. Then there was a little weather event, and now we're back to 270 at the same time as oil ran. But it sets up a constructive natural gas price long-term. And Sandridge is interesting because of its Mississippi lime, historically hated, lots of water, gas prices were low, lots of wells, emerged from bankruptcy, and now it sits on a marginal gas play, but a huge amount of inventory. So walk me through the thesis on that one.
Yeah, so it's interesting for even more reasons than that. Before that, there's one thing that I meant to mention when we were talking about the stock market running, even with, COVID, with the stock market running, even with a potential Biden administration, and even with some of the negative regulatory and tax issues. And a friend who actually you had on, I think it was also in May or early June, Harris Kupperman.
Will be coming back on later after this episode comes out. He'll be out next week too.
He should. He's fascinating and brilliant. And he came up with this framework. He's extremely good at finding macroeconomic trends and finding good investment theses on those macroeconomic trends. He's like one of the best. And I think he'll be famous in 30 years, similar to some of the macro people that people think of, like a Jim Rogers or a Soros or whatever, from an investment perspective, because he's really good at this. And he came up with this framework. He's called it Project Zimbabwe. And his observation was that in Zimbabwe, they did crazy stuff, like I mean, you could argue that Obama did crazy stuff too, but like even crazier stuff than what the Obama administration did in terms of increasing the regulatory risk and burden by a lot, increasing the tax burden risk by a lot. And the stock market in Zimbabwe went up 5x over like a year or something because they printed so much money. And his observation is that, hey, the Federal Reserve's printing all this money, or at least creating a lot of money. They don't really print it. That in the face of almost unlimited stimulus that's monetary, you just want to be long inflationary assets and you end up doing really well. And it does seem like the stock market is misinterpreting inflation and is priced in like growth stocks at really, really high valuations. And maybe you mentioned that maybe it's changing, maybe not, we'll see. But eventually printing tons of money and the national debt inflating like crazy and the monetary policy getting extremely loose for long periods of time does lead to asset price inflation. And so, it's what led to the housing bubble in the US in the early 2000s and housing bubble number 2, which is 3 times bigger now, as well as, across a number of assets. So
can you, before we keep going, because I agree, and I'm going to talk more with Harris about that. We talked about it on the first episode that you can get on www.hottakeoftheday.com, and all the archive podcasts are out there, including the one with Josh Young and with Harris Kupperman. You said that the housing bubble is 3 times larger today than it was in 2008, if I interpreted what you just said correctly.
Yeah, I mean, like, I don't know if it's exactly that, but like if you look at the Case-Shiller index, the Case-Shiller index is higher. I mean, right now in like San Francisco and New York and whatever, it's a little complicated because of suburbanization. But then you look at the places people are moving from those places and there's insane inflation, home price appreciation, measured inflation. So yeah, I mean, like it's a bubble like we've never seen in real estate right now,
which is
even more than the stock market.
Right, which again is crazy. And I think that again, somehow, and I don't know how to balance all these forces, because very clearly the market, and to your point, if you need inflation, and I've had Paul Sankey on before, and he talks about inflation. And in an inflation world, oil needs to be higher. To have inflation, oil needs to be 50, natural gas needs to be 350 or 4, pick your number. And so regardless of supply demand, from an inflation basis only, you're going to need to have oil prices that are higher. On top of that, current low prices are discouraging investment, which is going to lead to declines, which is then going to create more fundamental backdrop for a tighter market, both of which are good for commodity prices longer term. And if you identify a company, such as a Sandridge, let's use as an example, who's going to survive because they don't have debt, has assets that are worth more at a certain constructive price than they're currently trading at, then certainly there's a value accretion just from an NAV perspective that sets up a very positive trade. Is that a fair summary of it?
Yeah, I think that's like a good start. I think when you look at the backdrop of house prices up 10 or 20x over the last X number of years, 20 years, 30 years, whatever, and you look at how much oil or natural gas are up over that same time frame, I think 50 is way, way too low. And one of the benefits of owning things versus publishing research is I don't necessarily need to be popular, I just need to be right. So I guess that'd be my pushback on that particular analyst and those particular comments, and kind of the flavor of the day versus just like owning the same stuff that is value accretive, and when something doesn't make as much sense, selling it and buying something else that like is just as value accretive. So that'd be my pushback on those specific kind of price targets for the commodity or whatever. But I think from a company perspective, you can do really well just doing what you do, which is this like smog. And the thesis for Sandridge is pretty simple. We don't have to be right about the commodity price, inflation. We don't have to write about a lot of things. Just purely from your analytical perspective, from a smog, which is the simplified measure of the oil and gas reserve value, excluding taxes or after taxes, and Sandridge has huge NOLs, so they don't really have to pay taxes. for a while. So just based on that, it would have been more than a triple just to trade to its proved reserve value from where I published my thesis a couple of weeks ago on it. So that's like a starting point. I like to be able to be wrong on a lot of things and still potentially make money, potentially make a lot of money. And then if some of the macro stuff works out well for Sandridge, there's the potential for the stock to do much, much better because if they end up experiencing $3.50 or $4 gas, if their gas inventory goes into the money, that could be $20 a share of value. I know it sounds funny, but it emerged from bankruptcy at a $20 per share price. So obviously at that point in time, there was this view that it was worth that, and gas prices were way worse then, and there was higher service costs and stuff. So there was like more of an issue from an intrinsic value perspective then. Now.
So before we talk about Tamarack and go north of the border, the pushback that I struggle with, and this is an overarching problem I have with oil and gas. A lot of people will reach out and say, David, do you want to get back into the space? I obviously would love to, but I don't necessarily see a compelling value thesis for PDP. And here's the reason. If you have 4,000 wellbores, I don't know the number standard, so I'm just pulling a random number. But if you have 4,000 wellbores producing 40, 30, 50 MCF a day, and each abandonment is likely to cost between $50,000 and $100,000 in a very simple place. So abandon the well, reclaim the surface, turn it back to the world. When you do the math on that, the sheer amount of capital required to abandon the number of wells as offset by the cash flow, I always get scared around valuation. And reserve auditors can, because we're using PV10, they can put it off 40 years in the future. So the PV10 of that is like zero. And I get that. But in my mind, there's just this big liability that is being discounted too much, because at the end of the life of a well, you haven't reserved $500 million to go abandon a whole bunch of wells. The company just goes bankrupt. Now, that being said, you're discounting, you're using 10%, so 10% of costs and 10% of reserves and 10% of price. So there's a balance, but that's the concern I have about guys like Sandridge. It's just the sheer number of wells it takes for them to produce their cash flow. How do you think about that, and how do you respond to that criticism?
Yeah, I mean, it's a great question, and I spend a lot of time looking at asset retirement obligations and looking at kind of those exact issues. I think you kind of answered it to some extent, which is that it is discounted. So it's kind of like, okay, is this happening now? Is it happening in 3 years? Is it happening in 40 years? If it's happening in 40 years, there's a lot of things that can go right in between now and then for that to become much less of an issue. And if it's happening in 3 years, obviously you're going to have fully discounted it, and you're going to have fully understood kind of exactly what the capital requirements are. So when you look at a Sandridge with, I think it's 1,100 wellbores, you can look at it and say, hey, this is an issue because they have 1,100 wellbores. Or you can say they have a saltwater disposal system that they almost sold for $1 billion in 2014 or 2015. And they have a giant amount of other infrastructure, and they have all these pads, and they're all set up. And so if gas prices do recover, you don't need them to recover nearly as much as you need them to from a full cycle perspective. You can come in and do quarter cycle type stuff and half cycle type stuff, and you have like this running start. And if you ever do that, which I would bet in the next 30 years, the Mississippi line becomes economic again. And that's maybe an unpopular bet, but at like 1 times EBITDA with no debt, I feel like that's very asymmetric, especially if we're in an inflationary environment or potentially hyperinflationary environment. Even with regulations, even with whatever, it's still a very promising brownfield type, pretty huge option. It's actually like pretty promising, I think. And we're in an environment where we're not that far away from gas prices in a gas strip. Or a week back, we were at a gas strip that actually made sense for Mississippi Lime relative to service cost.
Yeah, no, that's fair. So now how about north of the border with Tamarack? What's the view there? Again, this is not a name I'm familiar with at all.
Yeah, so the CEO of Tamarack is Brian Schmidt. He ran Apache Canada back when running Apache Canada mattered. Like they had like $1 billion a year capital budget or something like.
I remember those things. Yeah.
Yeah. So, I mean, he was the guy, right? So he went on his own and got Tamarack started, and it was this like small public that was just like chipping away. It was a little bit like the catch if you can thing where you drop two mice in two different barrels of milk, and one of them drowns and the other one just like keeps pedaling, and he just kept paddling, and he's turned his milk into cream, and he has 22,000 plus or minus BOEs a day. And embedded in that is a water flood that's working enormously well, to the point where it's self-funding, and it'll be at about $80 million a year run rate free cash flow on strip 5 years from now, versus a $200 million market cap with a projected less than 10% decline rate. That free cash flow incorporates likely necessary kind of reinvestment to keep it flat. And that's like potentially keep it for 10 to 30 years, generating that sort of free cash flow versus a $200 million market cap. And that's just one asset that they're generating almost no cash flow from today, that has very little technical risk. It's already working. That has a lot of risk assumptions built in that are being exceeded. And so you have this like conventional producer, they have some unconventional horizontal stuff, and then they have this like essentially free water flood that's probably worth 2 or 3 times where the market cap is right now. And you have like competent management that came in and bought that asset, just paying the kind of primary recovery value, and actually executing on their plan and doing it cheaper and doing it better than everyone expected. It just took a long time for them to do it.
So and I like both those theses, because again, and I don't think this is going to be a surprise, it does show that we're not on different sides. We both have a value slam, and a little plug for my sister's company, a very small Vancouver exchange listed Hemisphere Energy, but they too have water floods, and water floods. For those who talk about conventional assets, I think that a lot of the good water floods that exist that haven't necessarily been converted have been overlooked, and there are some great opportunities. Now, getting those assets from companies into a private equity model is virtually impossible. But yeah, there are some shimmers of gold where you can create with just injecting water, improving recovery factors into a rising commodity price environment, and that makes a lot of sense. I think the secondary point that you made is that a unloved gas player with zero debt, who's come through bankruptcy, who has an unlimited amount of NOLs for all intents and purposes to never have to pay tax. And in a world where Tesla matters, people forget that right now 30% or so of electricity in the United States is generated from coal. And as more EVs occur, wind and solar, there's not always going to be an ability to have tier 1 wind and solar, and you'll need backup generation, which is good for natural gas. Declining oil is good for natural gas. And so that sets a context where a gas player, appropriately valued, makes a lot of sense. I find it interesting that you didn't mention a Chevron or an Exxon as value, notwithstanding that they've both kind of run 20-25% in the last 6 days on hopes of vaccine and demand and oil and et cetera. And so I think we're very much aligned. When I look at the U.S. shale producers, my core challenge, and not surprising, is oil at 41, and the strip, albeit maybe wrong, out 3 years is now still like 43, 44. And I am not aware of any shale plays over time that at 43 or 44 can sustain significant and substantial rates of return that are above the share prices of these companies. And so the only thing that I can't factor in is inflation, because, and then that's a whole different thing, right? Bonds are trading as though inflation is not going to happen. My understanding of inflation from the 80s is if inflation is 10%, interest rates have to rise to suppress inflation. And so then there's a whole bunch of other issues brought in by debt. How do you when you think about inflation, how are you going through that brain muddle that I just talked about?
So we're seeing yields get compressed by Federal Reserve intervention in the bond market. And so the Federal Reserve is actually buying those bonds and sending the yields down a lot by sending their prices up a lot. And they're actually participating in new issues. if you want to think about how scary and crazy that is, they're not just participating in new issues of federal government debt. So they're not just monetizing the debt, which they are doing, which is like absolutely terrifying, and like what you saw in Zimbabwe and whatever that killed the currencies. And like even like Citibank is projecting now a pretty large fall in the US dollar over the next year.
That's a 20% fall in the US dollar, which is against like a basket of Japan and Europe, who are also really weak. So how we're 20% worse than like we're like the shortest midget, and it's like, I don't know how we're worse than them.
Yeah, I mean, it's interesting, right? You see like inflation assets that are liquid, like a Bitcoin or a whatever, or like real estate where there people want them and they're trading up a lot. I guess my point is that the bond interest rate is not indicative, I think partly because of Federal Reserve market intervention. So that's, I think, one reason not to kind of push on that or focus on that. There is another aspect of these investment theses that I think we probably agree on, both with the not owning like the Exxons and Chevrons, just they're not cheap on reserves, they're not cheap on cash flow. If you view them as bond replacements, they're interesting, but if you view them as like fundamental intrinsic value equity investments, they're not. And a lot of the shale guys, I think, are kind of similar to your point. But the other aspect that I think is worth touching on a little bit, and something that I've started focusing on more, and is like maybe even a difference from what we had talked about a number of months ago when I was on, was there have been huge moves in basis differentials. So like what you can get for gas in Canada or NGLs, so like what Tamarack is making on their gas, they're mostly oil focused, but their gas is way more economic. Or Sandridge in the Mid-Con, where their differentials were abysmal for gas and NGLs. As they go from horrible margins and horrible local realized prices because of uneconomic activity by like the Gulf ports of the world as they go bankrupt, or the continental resources as they like try to build inventory and plays that make no sense with too much infill development and whatever. As that activity falls off, you see local pricing get a lot better. So you don't necessarily have to believe in, let's say, $4 natural gas overall to think that Sandridge is going to have $1 price improvement relative to their realized price for natural gas a year ago. And so you can like win from just like less like crazy bad stuff happening, right? Which is, I think, my favorite setup. It's like Sandridge was like a 1, right? You mention it to people and they like, if they're an investor in your fund, they like want their money back. If they're an investor of any kind in public equities, they've lost money on it. And like, frankly, like even the management team that bankrupted them was terrible. They were activists. They were brought in to fire Tom Ward, who had done a lot of things. I actually think Tom Ward and Aubrey McClendon were both like unfairly impugned. Like they did stuff, but they also did good stuff. The people after them were just disasters. Like they were worse, I think, because there weren't some of those like redeeming characteristics of founders who are passionate and whatever. And then Icon came in, replaced the board, and brought in like one of the most value destructive, like presided over a 1-year period where they destroyed $18 a share of value for Sandridge in a year. I mean, it was amazing. So the management up until recently was like abysmal too. And so as that's undone, and as now there's a competent person running it with a good business plan and value creation instead of destruction, there's all these things that people hated. But the local price is a big factor that I think can get missed in this kind of like bigger kind of wonky like inflation, whatever, that ties into what you're saying. Hey, like the Mid-Con guys were destroying a lot of value. They're not drilling that much anymore. Now the existing production might be worth a lot more than people were thinking because the local price is a lot better.
Yeah, I mean, and it is definitely going to be interesting. And I think from an M&A standpoint, just in terms of a short-term win, there are companies who are relatively overvalued, who have relative debt problems and relative cash flow problems. And for them to be able to bolster on a accretive offsetting play, a Sandridge may end up being a complementary PDP acquisition for someone who's already in the Mid-Con and maybe isn't spending a lot of money, and it can really help bolster their net asset value equation. And one of the things I will give Chevron credit for was I thought the Noble transaction was good, because Noble was trading relatively about NAV at a different price deck, and Chevron's trading about 2x. So just by bringing Noble into the fold and accelerated their Mediterranean and other assets internationally, I think that sets up very well. I still think Chevron's massively overvalued. Now, before we close, do you follow ducks at all? I wanted to talk ducks briefly.
Yeah, but before that, I'll just pick on, so if Chevron did a good deal by buying Noble, was the other deal they tried to do a bad deal?
Are we talking about Oxy?
It did basically almost sink that other company that ended up buying the thing that Chevron tried to buy last year.
Well, I mean, it's an absolutely interesting point. And I think, as an investor, both you and I, when you look at a backdrop to a commodity, when oil is 73, you make different decisions than when oil is 40. And very clearly, Chevron was willing to buy Anadarko at a value of approximately 65 a share plus debt. And debt, as you know, because of Western Gas, was a substantial portion of that deal. But the balance sheet of Chevron was obviously much bigger. And, they could have carried it. I think in the context of when the deal was done, the Noble deal clearly was better. And interestingly, also had a huge amount of Colorado risk, which Chevron must have got comfortable with in the Anadarko world, which then I think sets up a very interesting what happens to Oxy. People know I'm a fan of Vicky, but I'm not a shareholder. And clearly in $40 world with that level of debt, I don't personally know how they survive, but that's neither here nor there. The assets should come together. Anadarko and Chevron always should have come together. Anadarko and Noble. So it will be interesting to see how Oxy, Chevron over the next 3 years or so, if we see something there. Do you have any speculation on it?
No, but on the M&A stuff versus Sandridge, my thesis for Tamarack and Sandridge and most of what I own is not at all dependent on M&A. Both of those companies have accretively purchased small assets adjacent to them recently, so that's good, and I like that, and I want them to do more of that. But I think if you own something hoping for someone else to bail you out or buy the stock to drive it up, that's a really hard thing. And I think it's what got a lot of the oil and gas private equity funds in trouble on their more recent vintages, because that's the whole business model, is someone else buys you out. I think it's something that's gotten public equity investors in trouble on a lot of oil and gas. And I think we'll get them in trouble on other stuff too. There's this hope of a greater fool to buy the stock from you, or someone else to buy out the companies. Whereas for both of those companies, they generate giant amounts of free cash flow that I think will eventually be at least partially directed towards paying a dividend or towards large scale share repurchase. And so I think if you have a thing that's self-funding to the point where it's able to do that, I think it's way more interesting. And when I got into this business and went out on my own to start in 2010, there was this family office that had their money from oil and gas that had co-invested with me, and they invested a little money with me. And they said, look, you want to own oil companies that are the bank, that don't need the banks. And so, Sandridge is the bank at this point. Tamarack's not the bank, but it's pretty close. It will be. So I think that's a different framework.
And you're absolutely right. And I think just for me, when I think about M&A and I think about where our space needs to go, there are a number of parties who are looking, saying, okay, I need more cash flow to service my debt. I need to bolt on. I'm willing to pay an equity premium to do it. So all it will do is accelerate, but it certainly doesn't undermine your key thesis. So if we talk ducks, I did a blog post this weekend talking about ducks, and I had never looked at it this way, because if you look at the EIA duck report, a lot of people say, well, it's inaccurate, who knows, and there's a lot of wells that will never be completed. So I said, okay, so let's assume that when the bottom of the market occurred the last time, it was March 2016. That was the low of rigs. Oil had been falling through 14 all the way through 15. Companies had 16 months to redo their plans, and they were looking at a $40 oil price. So they said, okay, the only wells I'm going to drill in 2016 forward are going to be my tier one in a $40 to $50 world. So I zeroed out all of the ducks pre-January 2016 and then just looked at a material balance. And what I found was that the Niobrara and Appalachian region very heavily completed ducts from the previous time. And that the others had been working off their ducts, but were generally flat. So Eagleford and Haynesville and Bakken. But the Permian grew from something like 700 ducts in 2016 to 2,400 net ducts today. And we've seen rig count increasing with all these undrilled wells that have been drilled post-2016. I'm curious what you think operators are doing and how much of a game they think they're trying to play with backfilling declines this year to make cash flows look good for their spring redetermination and to get reserves on the books because they're running a rig so they can tell their auditors, I'm running 4 rigs, but then they're immediately going back to 0. Do you think about that, and are you seeing some odd behavior that's making you scared that oil companies haven't really learned the lessons of the past and are doing exactly what they've been doing for the last couple of years, or where do you feel?
So we're not seeing the level of kind of frac stack activity that would make me worried about that. So we're still way, way down year over year. And sure, there's like some improvement, or I guess from your perspective, negative, the growth in frac stacks is, substantial relative, like let's say month over month or from the bottom in, let's say May or June. But it's still really, really low. And what we haven't seen that I think is a really big difference in the story, and a reason that I'm bullish and actually think that oil and gas commodities and the equities recover sooner than you're thinking, is that there is not the same sort of productivity improvement that we saw in 2016. So like wells aren't getting a lot better right now. They were getting a lot better in 2016, and they're not getting a lot better right now. So in 2016, you didn't need a lot more frac stacks coming on to show oil production flattening and then increasing, because the wells were getting a lot better. One Energy was out there and, taking wells that were 200 barrels a day to 1,000 barrels a day. And it's like a very exciting, sexy story. There's not 200 barrel a day to 1,000 barrel a day improvements right now. If anything, there's actually kind of decreases generally across the industry and productivity. So I just don't think it's as big a concern, and I don't think it's a direct analog. So I think it's smart to watch that. But I think more important is kind of just the overall well productivity as well as the overall frac stack count, more than the drilling rig count, because the drilling rig count, to your point, like there's some like funny business that happens there, and some of that's to hold land and some of that's to show whatever it is that people want to show. And I don't think the people are any different, right? If you gave an oil company CEO a ton of money to go drill wells, they'll drill wells. That's what they do. Their business is to poke holes in the ground. They have a hammer and everything's a nail. And so, so generally that's the, maybe not the turnaround guy who's the CEO of Sandridge, who like hates the oil and gas industry to some extent and just wants to not lose money no matter what. So, I like him and can trust him, I feel like, with my money. But I just don't see that same sort of concern as in 2016. And I think we'll see it in terms of oil production over the next year. Like it's really going to require way, way, way more frac crews running than we're seeing now. So I don't know in terms of exact number of ducks, but I guess that'd be kind of how I'd address that.
Yeah, no, it's fair. It will be interesting. I would go on a limb and say I don't think the U.S. grows production in 2021. And I think, to your point, even if you slam a whole bunch of frac spreads to ducks, where you can incrementally and on a half cycle basis really accelerate cash flow, I think that the core problem is that production was at a level last year of, we call it 100, and it's down 30% because of low activity in 20, and prices are down 30% on top of that. So margin compression is just reducing so much flexibility to go do that program, add debt repayment, G&A, and there's just not that, and dividend payments, there's just not that much left to grow U.S. production, which I think from the macro world standpoint is constructive on oil prices long term.
Yeah, so I agree with that. I think that's right. I mean, I don't know exactly. Maybe we'll see a little bit of U.S. production growth, relative to a low base. Maybe we'll see it flat. I'm not sure, but I think there's kind of like what you're describing reminds me of like a magician, right? There's like what they focus you on, and then there's like what's actually happening. And this is like my sandwich thesis, like even simpler. It's basically everyone is focused on natural gas and they're focused on oil. And they have these different investment theses and like how many ducks and how many whatever. It kind of doesn't matter, right? Even if US production was going to grow by 1 million barrels a day of liquids, the thing that's going to happen that is so incredibly exciting for a relatively small set of extremely, extraordinarily undervalued producers is that NGL production is going to be massively down year over year, but fractionation capacity is up substantially because of the generous efforts of the Enbridges and whatever enterprises and whatever of the world. These guys are all building all this stuff to process liquids that they had an amazing margin on and now have much less amazing margins on. And so if you're a sandwich and a third of your production is NGLs that you were getting, I think the realized price was like $4 a barrel or something in Q2, and it went up to like $12 or $13 a barrel in Q3. That's the story. Like there's the where the magician is pointing you to, which is oil and natural gas. And then there's like the producers, or like Antero, we talked about that a little bit on our last conversation. Like they have some unhedged NGLs and their realizations are great, even with terrible oil prices. And so I think, Antero is complicated, it's levered, and it's, closer to fair value, let's say here, relative to where it was, at 70 cents or whatever. But like sandwich at $2 or $3 or $1, whatever it is, like it's not pricing in the thing that's changed the most by a lot, which is kind of this supply and demand for NGLs. And so to me, that's where like there's real value add in analyzing specific E&P companies, because you can kind of find this sort of thing that is not really so tied to the index. And sure, it goes up when oil and gas stocks go up and goes down when they go down, but like the cash flow is so differently connected, and there's so much potential upside from this thing that you and I think would agree on and is already happening.
Yeah, you and I definitely agree there. I think that there will be unique and special opportunities to get value at some point in the cycle. And the key is the person needs to look very hard and not be distracted by the hands of the magician. So, Josh, I always appreciate having you on the show and getting your insights. I think that your approach to investing and the way you're thinking through those theses hopefully give those listeners a little bit of a more warm, fuzzy optimism than they usually count on from the DR Dubs here. And so I hope you have a very happy Thanksgiving. Appreciate you spending the time, and look forward to our next conversation.
Thank you very much.
Until next time, be safe, be good, have a great day.